everyone, and welcome to another deep dive with us. We're going to be taking a look at the Indian stock market today, as always.
Absolutely.
And trying to make sense of all this financial data and news that's coming out. We're going to be drawing from a recent report by Motilal Oswal Financial Services.
Yeah, MOFSL.
MOFSL, that's right. The report's called The Eagle Eye. And it gives us a lot to talk about, a lot to dig into, as always. So we're going to equip you all with the knowledge you need to confidently, navigate India's equity markets.
It's definitely been a wild ride so far, especially in the first part of 2025.
Yeah. So speaking of wild rides, MOFSL is saying that India's market has actually taken kind of a downturn. It hasn't been performing as well as some other, similar economies.
Yeah.
So can you kind of break that down for us? What exactly happened? Did things really just nosedive?
Well, yeah, kind of. Think of it this way, right? The major indices, those are basically the scoreboards for like groups of stocks.
Yeah.
So like the Nifty 50, the Nifty 500, they represent the largest 50 and 500 companies listed on the National Stock Exchange of India.
Right.
Okay, so they've seen their market capitalization shrink. Like that's the total value of all the shares of those companies. And we're talking a decrease of 15% to 28% from their highest points.
Wow, that's a pretty significant drop.
Yeah, it is. And what's interesting is they're back to levels that we saw at the beginning of 2024.
So essentially, a lot of those gains that were made last year have just been wiped out. That's going to be tough for some investors, right?
Yeah, for sure. It's definitely a bit of a reality check. Over half of the stocks in that Nifty 500, the ones that climbed over 20% between February 2024 and when they peaked last October, have now dropped more than 20%.
Wow.
Yeah. So, it reminds us that markets can be unpredictable and what goes up must come down.
Always, yeah. Okay, so I have to ask, is this a free fall or is this like a normal market correction? Because you always talk about the importance of taking a long-term view.
You're right. Perspective is key. And I think when you zoom out and look at the big picture, this downturn is actually pretty normal. It's close to what we consider a typical market correction.
Okay, phew. So based on, historical data, how long does it typically take for the market to bounce back from something like this, from a correction?
Well, if we look at the Nifty 50, which again is India's benchmark index, it usually takes around 200 days for it to get back to its previous peak.
Okay, so if history repeats itself, we might be getting close to the end of this kind of rough patch. But I'm curious, how's India doing compared to the global market? Is this a worldwide thing or is India doing its own thing?
Well, while India's been having this downturn, the global market's painting a different picture. It's kind of a mixed bag, to be honest.
Okay.
On one hand, you have the U.S. stock indices. They're continuing to climb, which is kind of different from what we're seeing in India, right?
Right.
But then you have MSCI China, the index that tracks Chinese stocks, and that's rebounded strongly from its lows. So it's like each region's reacting differently to all these global things happening.
It's fascinating, right? It's like they're all dancing to different tunes. And speaking of different tunes, this is something I've always been curious about. What about the relationship between how the Indian market performs and U.S. presidential terms? Is there any link there?
That's an interesting one. It's definitely not a direct cause and effect,
right?
But there are some observations we can make. You see, the Indian markets, specifically Nifty 50, have generally done well under different U.S. presidents. But during the current term, we've seen some underperformance.
Interesting. So are you saying there might be a Donald Trump effect that we should be watching out for? Because his second term has kind of coincided with some market ups and downs, hasn't it?
Yeah, you could say that. There has been more volatility in the Indian markets since his second term began, especially in the last, I'd say, 4 or 5 months. It's definitely something to keep an eye on.
Okay, noted. Now, shifting gears a bit, with the stock market being a bit shaky, do you think this is the time for people to start thinking about gold? I mean, it's usually seen as a safe haven when things get uncertain, right?
You're absolutely right. Gold often shines when markets get rocky. And it's seen a surge in demand lately, especially from central banks in those emerging markets.
Right.
They're using it as a strategic tool to kind of manage risk in a world where the U.S. dollar's dominance might be facing some, challenges.
Yeah, it's like they're hedging their bets, adding gold to their portfolio.
Exactly. And there's another reason, too. These central banks are looking to diversify their reserves. They want to move away from relying so heavily on the U.S. dollar.
So reducing their dependence on the dollar makes sense. But how does gold actually fit into that strategy?
Well, gold acts as a hedge. It helps them protect themselves against the risks of, relying too much on one single currency, especially when that currency is facing some, headwinds.
Okay, yeah. Starting to see the bigger picture here. So how has all this focus on gold impacted its actual performance in the market? Has it really lived up to this safe haven status?
Well, if you look at the numbers, gold prices have gone up significantly in recent years. And get this, for a whole decade, U.S. and Indian equities, stocks, they were outperforming gold. But in the last 6 months, there's been a shift.
A shift, really?
Yeah, gold has actually surpassed global equities in the last 6 months, so it's not just a safe haven anymore.
So it's actually delivering for people.
It is.
Wow, interesting. This whole gold rush, though, it makes you think about other investment opportunities that might be out there. What about specific sectors within the Indian market? Are there any bright spots in all of this?
That's a great question, and it leads us to another important thing that MOFSL highlights in their report. It's the performance of different sectors, like how some industries are doing better than others.
Yeah, yeah. We've talked about the overall market dip, but I'm curious, how is this all playing out across different industries? Like which ones are holding up well and which ones are feeling the pressure?
Well, according to MOFSL, private banks and the metal indices have been kind of the winners here. They've managed to weather the storm a bit better than other sectors so far in 2025.
Okay, can you give us some concrete examples? I always find it helpful to connect the dots with actual companies.
Oh, for sure. So companies like Bajaj Finance, Bajaj Finserv, they're in financial services. And then you have Maruti Suzuki, a big name in the auto industry. They've actually come out on top as gainers.
Wow, that's impressive.
Yeah, but then on the flip side, you've got companies like Trent's, the retail giant, Dr. Reddy's, the pharmaceutical company, and BPCL, which is in oil and gas, and they've had some pretty big drops.
Oh, wow. A real mixed bag there. Some winners and losers.
Absolutely.
Are there any trends you're seeing in how these sectors are represented in the Nifty index? Have there been any changes in their weighting, which basically tells us how important they are in the overall index?
Yeah, there have been some interesting shifts. So the weighting of private banks and those non-banking financial companies, those are the MBFCs in metals. In the Nifty index, well, that's increased in February 2025. But the weighting of technology, autos, consumer goods, and capital goods, all those sectors have actually decreased.
That's really interesting. What do you think that tells us about how the Indian economy is changing? Are these shifts a sign of investors feeling differently, or maybe they're reflecting something bigger, like economic trends? Where should we be putting our money? That's the big question, right?
Yeah, that is the million-dollar question. And thankfully, MOFSL actually offers some insights on that. They recently published reports on the Indian logistics sector. They think it has a lot of potential. And they've also got a deep dive on earnings for the third quarter of the fiscal year 2025. We usually call that 3Q FY25.
Okay, I need to get my hands on those reports. What are some key takeaways from them that our listeners should know? Anything really stand out to you?
Yeah, I think from that earnings review, the big thing is that overall earnings growth in that 3Q FY25 was moderate. It came in at 6% year on year, but there were definitely some star performers, like the financials, healthcare, technology, and telecom sectors really did well.
Okay, so some bright spots in there.
Yeah, for sure. But here's the thing. Even with this market dip we've been talking about, the mid-cap and small-cap stocks, those are the riskier ones, but they have higher growth potential. Well, they're still trading at a premium compared to their historical averages. So that might suggest there's a bubble brewing there.
Oh, a bubble.
Yeah, something to watch out for.
That's definitely something to keep in mind. So when we talk about investors, everyone's different, right? Some people are attracted to that high growth, high risk world of the mid cap and small cap stocks.
Right.
And others, they prefer the stability of those larger companies. What kind of investor are you?
Yeah, it's important to know yourself and your risk tolerance. And this actually brings us to a really important insight that MOFSL highlights in their report. It's all about India's market cap to GDP ratio. Right now, it's above its long-term average.
Okay. Now that sounds important, but break it down for us. What does that mean for the average investor?
So basically, this ratio helps us figure out if the market is overvalued or undervalued compared to the whole economy. It's like a way to check if the stock market is accurately reflecting how the economy is really doing.
Got it. So where is India right now? Overvalued, undervalued, somewhere in between?
Well, like I said, the ratio is higher than its historical average, but it's come down a lot from its recent highs. And this raises a really big question. Does this mean it's a good time to buy, or could the market fall even further? It's something to think about as you're navigating your own investment journey in the Indian market.
Definitely a lot to think about. It seems like we've only just scratched the surface of this whole eagle eye report.
Yeah, we have.
There's so much more to explore. We're going to dig deeper into this dynamic landscape in part 2 of our deep dive, so make sure to stay tuned for that.
See there?
All right, so welcome back to our deep dive into the Indian stock market. We're continuing to explore MOFSL's The Eagle Eye Report. And I got to tell you, things are about to get even more fascinating as we, dig deeper into all these dynamics and these different trends.
Absolutely, yeah. There's so much to uncover here. We're just getting warmed up.
I love that. So before we move on, I want to go back to our chat about gold for a second. It's been like a really hot topic lately with all these central banks around the world. It seems like they're just buying up as much as they can.
Right, right.
You mentioned that they're trying to, diversify their reserves and be less dependent on the US dollar.
Exactly. It's all about managing risk.
Hmm.
In a world where the dollar might not be as strong as it used to be.
Right. It's like they're hedging their bets by adding gold to the mix. But I'm curious about what this all means in practice. How's this demand for gold actually affected the price? Has it really lived up to its, safe haven reputation?
Oh, it definitely has. I mean, gold prices have just skyrocketed in recent years, largely because of this huge demand from central banks. And it's interesting, if you compare it to, U.S. and Indian equities, stocks, they were actually outperforming gold for like a whole decade. But in the last 6 months, things have changed.
Oh, really? A shift in the tides?
Yeah, a real shift.
Yeah.
Gold has actually outperformed global equities in terms of returns over the past 6 months. So it's not just a safe haven anymore. It's actually giving investors some real results.
Wow, that's pretty impressive. So gold is like the new star of the investment world.
Well, it's definitely making a strong case for itself. It's showing us it can deliver.
Okay, so this whole gold rush, it makes you think about what other investment opportunities might be out there. What about those different sectors within the Indian market? How are they doing with this dip we've been seeing? I mean, we talked about the overall downturn, but I'm curious about, what's happening within specific industries.
Yeah, and as you might expect, it's kind of a mixed bag. Some sectors are hanging in there, while others are definitely feeling the heat. MOFSL says that private banks and metal indices have been the toughest so far in 2025, doing better than others.
Okay, can you give us some examples? I always like to connect the dots, with actual companies.
For sure, for sure. So you've got companies like Bajaj Finance, Bajaj FinServ, those are in the financial services space. And then there's Maruti Suzuki, a big player in the auto industry. They've actually been the top gainers.
Wow, that's really interesting.
Yeah, it's impressive. But then on the flip side, you have companies like Trent, which is that well-known retailer, Dr. Reddy's, the pharmaceutical company, and BPCL, which is in oil and gas. And they've seen some big dips, some significant declines.
Yeah, it's always a mix, isn't it? Wins and losses.
Always.
I'm curious about the trends and how these sectors are represented in the Nifty index, like their weighting. That tells us how important they are in the overall picture, right? Have you seen any changes there?
Yeah, there have actually been some pretty big shifts. The weighting of private banks,
Yeah.
those non-banking financial companies, the NBFCs,
Right.
and metals in the Nifty index, well, it's gone up in February 2025. But the weighting of technology, autos, consumer goods, and capital goods, those have actually decreased.
That's pretty fascinating. What do you think this all means for the Indian economy? I mean, are these changes, are they a sign of investors changing their minds? Or is this a bigger trend in the economy? It makes you wonder where you should put your money these days.
Yeah, it really does. It's the million-dollar question. And thankfully, MOFSL, they actually offer some insights on that. They recently published reports on the Indian logistics sector, and they think it's got a lot of potential for growth in the coming years.
Logistics, that's not usually the first thing that comes to mind when you think about exciting investment opportunities. What makes them so bullish on that sector?
Well, they see a bunch of factors coming together to create this perfect storm for growth in Indian logistics. For one, India's port sector is expected to really expand, with a projected annual capacity addition between fiscal year 2023 and fiscal year 2028.
Wow, that's significant.
It is. And it's being driven by, the increasing handling of different types of cargo like petroleum, oil, lubricants, coal, and importantly, containerized cargo.
Containerized cargo, that sounds like a play on global trade, right? I mean, as India becomes more integrated into those global supply chains, the demand for logistics is just going to keep going up.
Exactly. And they expect that overall cargo traffic will keep growing at a steady pace, which will lead to those healthy utilization levels at ports. And this growth is even more fueled by the expected rise in container traffic, which is projected to increase annually over the next 5 years.
So basically, the Indian logistics sector is kind of riding the wave of India's economic growth and its, increasing role in global trade. It's like a behind-the-scenes player that's becoming a major force.
That's a great way to put it. And MOFSL, they don't just stop at painting that broad picture. They've actually identified two specific companies that they think are in a great position to benefit from this growth. APSEZ, that's Adani Ports and Special Economic Zone, and JSWinFRI, which is JSW Infrastructure.
Okay, I'm taking notes here. Why are they highlighting these two companies specifically? What makes them stand out?
Both APSE and JSWinFRA are projected to grow a lot, even faster than the rest of the industry. They're seen as those key players who will benefit from this expansion of port infrastructure and the increasing demand for logistics services.
Gotcha.
What's also interesting is that they're not just, growing naturally. They're actively pursuing what we call inorganic expansion strategies.
Inorganic expansion, you mean like acquisitions and mergers. So they're not just growing, they're buying other companies and assets to, become even stronger.
Exactly. They're really solidifying their position and expanding their reach.
Yeah.
And they're not just sticking to, traditional port operations and logistics. They're moving into what's called integrated logistics solutions.
Integrated logistics solutions. So they're like becoming those one-stop shops for everything logistics, offering all those services to their clients.
Precisely, yeah. They're going beyond just moving stuff from point A to point B. They're managing the entire process.
Okay, starting to see why these companies are so appealing. It's like they're building these logistics empires ready to take advantage of India's economic growth. But what's MOFSL's official stance on them? Are they recommending them to investors?
They are. They've given both APCs and JSWinFRA a buy rating. They're really optimistic about their prospects, and they've even gone so far as to name JSWinFRA as their top pick in the whole port sector. So yeah, if you're interested in the Indian logistics sector, these companies are definitely worth looking into.
That's great insight. I know that MOFSL doesn't just focus on specific sectors, though, right? They also look at the broader market performance, including earnings season. So what's their take on earnings for the third quarter of the fiscal year 2025? Are companies doing well, or are there any surprises?
Well, it's a bit of a mixed bag, Some sectors are exceeding expectations, while others are facing some headwinds. Overall, the aggregate earnings of companies in the MOFSL universe, they actually met their estimates, showing a 6% year-on-year growth.
Okay, not too bad.
Yeah, but there's a nuance here. The performance was affected by those global commodities, specifically metals and oil and gas.
Oh, interesting. So those sectors that seem to be doing well in terms of price, they're actually dragging down earnings overall.
Exactly. It reminds us that price movements and earnings, they don't always tell the same story.
Yeah.
There can be things affecting profitability even when stock prices are going up.
Right. Makes sense. So what if we, take those commodity-heavy sectors out of the equation? Does the earnings picture change?
It actually does, yeah.
Oh.
If you remove metals and oil and gas,
Right.
the earnings growth for both the MOFSO universe and the Nifty 50 index, it jumps quite a bit.
Yeah.
So it seems like the underlying strength of the market is kind of hidden by those challenges in those specific sectors.
Okay, so some sectors are doing great while others are facing those headwinds. How's this all breaking down across those different market segments? Large cap, mid cap, small cap stocks. Are there any patterns there?
Oh, for sure. So in the third quarter of fiscal year 2025, large cap earnings in that MOFSL universe grew by about 5%. Pretty modest. But mid caps, those are the ones with that high growth potential, well, they saw a way more impressive 26% earnings growth. Small caps, on the other hand, experienced a 24% decline in earnings. So yeah, it's mixed.
Yeah, mixed.
Mid caps leading the charge, but small caps are having a bit of a tough time.
Yeah, we talked about that potential bubble in the mid cap and small cap space earlier. So it's a reminder that you got to be careful, right? It's not just about growth, it's about understanding the risks.
Absolutely. Risk and reward go hand in hand. And MOFSL actually takes their analysis a step further. They don't just look at earnings growth, they examine what's driving it.
Okay, let's dive into that. What sectors are really contributing to that earnings growth and which ones are lagging behind?
Well, the stars of the show in the third quarter of fiscal year 2025, at least in terms of earnings growth, were the financials, healthcare, technology, and telecom sectors. They were the real drivers of those aggregate earnings. But like we discussed, those commodity sectors, metals and oil and gas, they kind of weighed things down for the overall Nifty 500 index.
Right.
So yeah, it's a tale of two markets. Some sectors are booming, while others are dealing with those external pressures.
Yeah, a real mix. How does MOFSL see all this playing out in the future, though? Do they think these trends will continue?
The projections for fiscal year 2026 indicate that financials, oil and gas, and metals, those are going to be the main drivers of growth for things like sales, EBITDA, that's earnings before interest, taxes, depreciation, and amortization, and BATA, which is profit after tax. So it looks like those sectors are going to be in the spotlight for the coming year.
It sounds like investors really need to consider all these different factors when they're making their decisions, right? It's not just about following the overall market, it's about understanding the nuances of those sectors, the different market segments, and all those global influences.
Exactly. It's like a complex puzzle, and MOFSL's report gives us some valuable pieces to help us navigate it all.
Yeah, a roadmap for our investments. Well, it's clear that we've only scratched the surface of this report. There's just so much to uncover, especially when it comes to valuations, which is like the heart of investing, right? Are we paying too much for some things, or are there hidden gems waiting to be discovered? We'll unravel all those mysteries in part 3 of our deep dive, so stay tuned for more insights. Welcome back to our deep dive into the Indian stock market. We're using MOFSL's The Eagle Eye Report to, navigate this whole financial roller coaster. And now we're getting to a super important topic: valuations.
Yeah, valuations, that's all about figuring out if something like a stock or a whole market is priced right. Like when you're shopping, you want to know if you're getting a good deal or if you're paying too much.
Right, like checking the price tag before you buy something, but in this case, the purchase is an investment.
Exactly, yeah. And just like you wouldn't buy something without looking at the price, investors shouldn't just jump into the market without understanding valuations.
Makes sense. So, big picture, what's MOFSL saying about how the Nifty 50 is valued right now? India's benchmark index, is it expensive? Is it a bargain, or somewhere in between?
Well, MOFSL's done a lot of number crunching, and they've got some interesting findings. If you look at the 12-month trailing price-to-earnings ratio, that's the PE ratio, for the Nifty 50, it's currently at 21.2x.
Okay, 21.2x. For those of us who aren't, financial experts, what does that actually mean? How do we know if that's good or bad?
So that PE ratio, it basically tells you how much investors are willing to pay for every rupee of earnings that a company, or in this case, a whole index, generates. A higher PE ratio usually means investors are feeling optimistic about future growth and are willing to pay a premium. And a lower PE ratio could mean they're a bit more cautious.
So to figure out if this current PE ratio for the Nifty 50 is high or low, we got to compare it to historical averages, right?
Exactly. And if we do that, we see that the current ratio, 21.2x, is actually 6% lower than its long-term average.
Interesting. So even though the Indian market has been down, it's not necessarily a screaming bargain based on this specific metric.
Yeah, that's right. But valuations are tricky. The PE ratio is just one part of the story. There are other things to look at. In different sectors, they can have really different valuations.
Okay, I'm getting the sense there's more to this. What other valuation metrics should investors be thinking about?
Another common one is the price-to-book ratio, the PB ratio. This one compares a company's market price to its book value, which is like the net value of its assets.
So it's comparing what the market thinks a company is worth to what its assets are actually worth on paper.
Exactly. And according to MOFSL, the 12-month trailing PB ratio for Nifty 50, it's at 3.3x right now. And this time, it's actually 5% higher than its historical average. So we're seeing a different story compared to the PE ratio.
Okay, so the PE ratio is saying the market might be a bit undervalued, but the PB ratio is saying it's a bit overvalued. It's getting complicated.
It is. It's all about looking at different angles and understanding the nuances. And then there's another layer, forward-looking valuations. These are based on what analysts think future earnings will be, so it gives us a peek into potential growth.
So we're trying to predict the future earnings of a company. Sounds a bit like a crystal ball.
Kind of, yeah. But these predictions, they're based on a lot of research and analysis looking at all sorts of factors that could affect a company's performance.
Okay, so what are these forward-looking valuations telling us about the Nifty 50?
Well, MOFSL says the 12-month forward PE ratio for Nifty 50 is currently at 18.6x, which is actually 9% lower than its long-term average.
Okay, so that's more positive, right? It means the market might actually be undervalued if we look at future earnings.
Right, exactly. And the forward PB ratio backs that up.
Yeah.
It's at 2.9x, which is just a bit above its historical average. So if we look these forward-looking numbers, things are looking a bit more optimistic.
So we've got the PE ratio hinting at undervaluation, the PB ratio suggesting overvaluation, and then these forward-looking metrics, they're giving us a more positive picture. It's a lot to take in.
It is. It shows how complex valuations can be. There's no one perfect way to measure it.
It sounds like investors really need to be careful and do their research in this kind of environment, right? Weighing all these different factors.
Absolutely, yeah. And that's where MOFSL's analysis is so helpful. They don't just give you the numbers, they dig deeper into sectors and market segments, showing us the risks and the opportunities.
Right. We've talked about the overall market, but are there any specific sectors that are like standing out in terms of valuations? Like, are there any bargains or any areas where we should be more cautious?
MOFSL has pointed out one area where we might want to be careful, and we touched on this earlier, mid-cap and small-cap stocks.
Right, those higher growth, higher risk stocks.
Exactly. Even though they've dropped a lot since their peak in September 2024, their valuations are still higher than historical averages. So it might mean there's a bubble there, and investors should be cautious.
So that bubble we talked about before, it's still something to watch.
Definitely. And it's not just those specific stocks. MOFSL says that except for large cap stocks and the banking sector, most sectors are actually trading at a premium compared to their long-term average valuations. So there's a lot of optimism out there, but it's important to be really selective and do your homework.
It sounds like a cautious approach is the way to go right now.
It's always smart to be careful, especially when valuations are high. But being cautious doesn't mean you can't invest. It just means you need to really evaluate potential investments, understand the risks, and make smart decisions.
So as we wrap up our deep dive into the Indian stock market, what are the main things investors should remember?
I think the biggest thing is that valuations are super important when you're investing. They can tell us a lot about whether an asset is overpriced or underpriced, but it's not always clear-cut. Investors have to look at different metrics, both historical and forward-looking, and they need to understand how different sectors work, what risks there are, like bubbles, and how much risk they're comfortable with.
That's great advice. Do your research, understand the risks, and invest wisely.
Exactly. Knowledge is key, especially when it comes to investing.
Well said. A big thank you to MOFSL for their awesome and informative report, and thank you to all our listeners for joining us on this deep dive into the Indian stock market. We hope you learned a lot and have a better understanding of this exciting market. Until next time, happy investing.